Let's turn our attention now to asset utilization ratios. These ratios relate the balance sheet items to income statement items. So we're going to look at receivables turnover, average collection period, inventory turnover, fixed asset turnover, and total sales turnover. Now, when you hear the term turnover, you need to think sales. Okay, all of these turnover terms are sales, which is from the income statement, divided by some measure from the balance sheet, some asset measure. So this first one, receivables turnover, sales credit divided by sales, which are credit sales, divided by receivables. Now, in this case, for our firm, all of the sales are on credit. If you go back and look at the income statement, you'll see that all of the sales are apparently credit sales. Having said that, if that weren't true, if we had a firm that had only half its sales that were made on credit and half for cash, then this receivables turnover, we would only want to use for calculating this ratio the sales that are actually made on credit. So our credit sales were $4 million and our receivables were $350,000. So the receivables turnover ratio was 11.4, which is slightly better than the industry average. Another way of looking at the receivables turnover, and it really doesn't give you any additional information, it's just another way of organizing the data, is this average collection period, which is the receivables divided by average daily credit sales. So this average daily credit sales right here is really just sales divided by 360, which is what we typically use as an estimate of the number of sales days. So you'll notice that receivables turnover and average collection period are essentially just an inverse of one another, except that sales is now expressed in terms of sales for the day instead of sales for the year. But I'll highlight it in red. Sales is in both of them. Receivables is in both. It's the numerator of one, the denominator of the other. And in the same way that our firm had better sales turnovers, the receivables as a fraction of daily sales is lower for this firm than for the other. It would have to be. If we're better on receivables turnover measure, we're going to be better on average collection period measure. Finally, here at the bottom of this slide, inventory turnover, which is sales divided by inventory. In this instance, again, we have more sales relative to our inventory level than our competitors do. The inventory is being taken from our balance sheet. We're selling our inventory through over 10 times a year. Our competitors are only selling through 7 times a year on average. Let's look at a couple of other measures. Fixed asset turnover. Again, turnover. Think sales in the numerator. Sales divided by fixed assets. The fixed assets is coming from the balance sheet. We're selling 5 times the level of fixed assets we have each year. That's pretty close to the industry average. And our total asset turnover, which is sales divided by the total assets that we have, is 2.5. The industry average is 1.5. We're doing considerably better than the rest of the industry on that measure. the next set of ratios that we're going to look to are liquidity ratios. And specifically, we're going to look at the current ratio and the quick ratio. Now, these liquidity ratios are essentially measures of the firm's ability to meet its current obligations from current assets. So the first ratio, current ratio, is just current assets divided by current liabilities. The current assets will be converted into cash in the near term. The current liabilities will be uses of cash in the near term. We see that our current assets are 2.67 times our current liabilities, so it appears that the firm is going to have sufficient resources generated internally to pay off those current liabilities as they come due. It's also somewhat reassuring to see that our current ratio exceeds the industry average current ratio. In other words, we have a higher level of liquid assets to current liabilities than the industry average. The quick ratio is sometimes referred to as acid test, but the quick ratio here is the current assets minus inventory. And the basic idea here is that inventory may in many cases be the least liquid of the assets that we have. Those assets are always available for sale, obviously. If we're selling our inventory, we're always trying to sell those. If we wanted to sell them in a hurry, we would have to mark the price down. We might not be able to sell them at the level that our book value suggests they're worth. Likewise, if we have inventory that's obsolete, we might not be able to sell it. So if we want to get essentially another measure, but a little more restrictive measure of what assets will be available to pay off our current liabilities as they come due, we reduce current assets by inventory, and that gives us what we refer to as a quick ratio. What assets could we raise in a hurry? What assets could we raise quickly? And we see here that our quick ratio is 1.43, which again is better than the industry average. Let's turn to our final set of ratios, debt utilization ratios, that are used to measure the prudence of the debt management policies of the firm. We're going to look at basically three ratios here, the debt to total assets, and then we're going to look at times interest earned and something referred to as the fixed charge coverage ratio. The debt to total assets is easy enough. We look at the debt on the balance sheet, divide it by the total assets on the balance sheet. We see for Saxton Company that our debt to total assets is not far from the industry average. It's a little bit higher, slightly higher than the industry average. Now we'll look at the next item, the times interest earned, which uses the two income statement variables. The first is income before interest and taxes. So we're interested in not net income, not bottom line net income, but the income before the interest expense. And on the income statement for our firm, for Saxton Company, we had $550,000 in income before interest and taxes. The denominator is the amount of interest that we have to pay, or that we have paid. So our times interest earned is exactly what the term suggests. We've paid $50,000 in interest. We have earned $550,000. We've earned 11 times the interest that we owed. That compares with 7 times for the industry average. So we have, while our debt level is a little bit higher, in fact our profitability is also higher, and we appear to be in better shape for paying our debt, to paying the cost of debt, the interest expense, than our peers, our industry peers, are on average. This last term, the fixed charge coverage ratio, is similar to the times interest earned ratio. It's capturing, in a sense, the same kind of information, but we're recognizing that interest isn't the only obligation that we have in a contractual sense. It's not the only fixed charge that we face, and in particular, we're interested in lease obligations. We may have assets that we have leased rather than that we own, and to the extent that we have leased assets and we have lease obligations, we have to earn enough that we can cover those lease payments as they come due, in the same way that we're covering interest payments. In a sense, we have contractual obligations to both. So the fixed charge coverage ratio, the numerator, is not just the income before interest and taxes, but the income before interest, taxes, and before any lease payments that we have. And the denominator isn't just interest, but is interest plus lease payments that we have. So interest plus lease payments is in the denominator. We put leases in the denominator, and we're taking leases out of the numerator. And I'm referring now to comparing the fixed charge to the times interest earned. When we move from times interest earned to fixed charge, we're reducing the numerator by the amount of the lease, and we're increasing the denominator by the amount of the leases. Let's look in a little more detail. So this fixed charge coverage measures the firm's ability to meet its fixed obligations, not just the interest payments, but also lease payments. So in this case, the income before interest and taxes was $550,000. Included in our operating expenses were $50,000 of lease payments. If you go back to the income statement, you will see an asterisk that notes $50,000 in lease payments. So our income before these fixed charges in aggregate is $600,000. We'll finish up this we'll finish up ratio analysis, or our discussion of ratio analysis, by looking at all of the ratios that we've calculated at this point. The profit margin for Saxon isn't quite as good as the industry average, so we're below average there. The return on assets, however, is higher because we have a higher asset turnover ratio. The return on equity is also better than the industry average due to the higher return on assets, and also due to slightly greater use of debt. Our asset utilization ratios in almost all cases is better. Our receivables turnover is better than average. Our collection periods, which measures the same thing, is better than average. The inventory turnover ratio is better than average. Our fixed asset turnover ratio is not quite as good as the industry average, which may mean we just are using more fixed assets relative to our competitors. But the total asset turnover ratio is above average. In terms of liquidity, we're more liquid than our competitors. We have higher current ratio, and we have a higher quick ratio. The debt utilization ratios, we have slightly more debt, not a lot more debt, but because of our higher level of profitability, driven by higher return on assets, and we have a higher level of times interest earned and a higher fixed charge ratio.